Assalamualaikum and hi everyone. This is the third presentation for part D for subsequent measurement under property, plant and equipment, and this is going to focus on revaluation model. Under revaluation model, the property, plant and equipment will be carried at the revalued amount. So the revalued amount will be the fair value on the revaluation date less any subsequent accumulated depreciation and any subsequent accumulated impairment loss. This can be best summarized here. So the total that you will get after the deduction of subsequent accumulated depreciation and subsequent accumulated impairment loss will be called revalued amount. And for this FAR210 purpose, our focus will just be looking at fair value less subsequent accumulated depreciation. So under revaluation model, the principles of the revaluation models, it has to be performed regularly and the frequency shall be stated at the notes to the account as an accounting policy, as well as if there is any significant or volatile changes in the fair value, it may necessitate annual revaluation. And when an item of a PPE is being revalued, the entire class of that PPE shall also be revalued. So MFRS116 does not allow selective revaluation for a class of property, plant and equipment. The fair value shall be determined from the market-based evidence, and we normally will be taking the appraisal done by the professional qualified valuers. If there is none, the entity may need to estimate the fair value using an income or a depreciated replacement cost approach. So under the subsequent measurement revaluation model, initially the property, plant and equipment is recorded at cost, which is the historical cost concept from the conceptual framework. However, under subsequent measurement, the option is given for a company, the reporting entity, to carry their assets, the PPE, at the market value. Remember, it is an option. And therefore, the recognition of that asset at the fair value, that is what we call revaluation. Let's look at accounting for revaluation. We will first start off with the surplus on revaluation. The carrying amount of an item of property, plant and equipment is increased. Increase meaning that it goes upward as a result of a revaluation. If that is the case, the market value or the fair value will normally be more than the carrying amount, and that will give rise to surplus on revaluation. That is also known as gain on revaluation, and sometimes it is also called revaluation surplus. Let's look at the first example of revaluation, and now let us start with depreciable asset. Depreciable asset is those assets that are subject to depreciation. So here is about a building, and that building has a cost on the date of acquisition 200,000, and the opening balance of the accumulated depreciation is 40,000. In the current year where depreciation charges took place, here is 10,000, and that was for the year ended 31st of December 2000 X8, which is the reporting date for this company, the end of the year. The fair value, this is the market based evidence of the company, which is 170,000. You are asked to advise the company on the accounting treatment. Advice on an accounting treatment is normally by way of giving some kind of a sentence in the form of explaining the accounting treatment. But before we can write that sentence form, we are going to first do some workings. So let's look at the first one here. The first one is that you need to determine first whether there is a surplus or a deficit. So we are trying to find a surplus. The first step is for us to calculate the carrying amount. The carrying amount here is to find out the carrying amount on the revaluation date. And in our case, revaluation date here is at the end of the year. Financial year here is 31st of December 2008. So the cost minus accumulated depreciation on that revaluation date. So you take the cost, 200,000, the date of the purchase of the building, and deducted with the accumulated depreciation. So the accumulated depreciation would be the balance brought forward of 40,000, the beginning balance, plus the current depreciation. Remember, we are looking at the depreciation or the accumulated depreciation on the revaluation date. And therefore, this accumulated depreciation of 50,000 is as a result of 40 plus 10. So there goes the carrying amount to be 150,000. Take that carrying amount and compare with the fair value. And here you could see that fair value is greater than the carrying amount of 150,000, and the fair value is 170,000. Therefore, there is a surplus of 20,000, which is also known as gain on revaluation. What do we do with the gain on revaluation? And in this slide, you can look at the workings that I've provided by way of table. So you can check this. And what you would see is that the next thing is for us to do journal entry. For the journal entry, you would see that we are going to do journal entry for the current depreciation charge, because there are charges for depreciation in that year. Remember, we are going to do the journal entry related to the revaluation. So these are the depreciation charge for the asset that were being revalued. And you also need to go and eliminate the accumulated depreciation on the date the revaluation took place. So there is one more journal entry here. And another one is to record the surplus. The surplus, there will be one more accounting entries needed. So let's look at the next a few things here, so that it is altogether 1, 2, and 3 journal entries. And these are the journal entries. The first journal entries is to record the depreciation. So the depreciation for that current year, because the revaluation took place at the end of the year. So you should provide the depreciation first. Next is to eliminate the accumulated depreciation prior to the revaluation. Remember, revaluation took place at the end of the year. Sometimes the accumulated depreciation is directly given, but in this case, you are supposed to calculate it on your own. So I've shown you how to calculate them. So go and write that to the building account, or to the carrying amount of the building. You are actually doing the write-off by eliminating them. Next is to record the surplus on revaluation. Surplus will be debited to the building account and will be credited to the asset revaluation reserve that relates to the building. And this one will be treated as an equity, the asset revaluation reserve. We'll see this in the explanation of accounting treatment. This is the 3-column ledger that shows the accounting entries related to the revaluation that took place at the end of the year. So these are the elimination of the accumulated depreciation in the 3-column ledger. These are the building account that is maintained at the revalued amount, being the fair value, and the surplus is credited to the asset revaluation reserve account. And that will later be presented in the statement of changes in equity under the asset revaluation reserve column. Next is the presentation in the financial statement. The depreciation would be charged, and of course 10,000 is the current depreciation, and the surplus will be disclosed in the other comprehensive income. So this is just a disclosure in the other comprehensive income. So that is not part of the statement of profit or loss. These are actually the disclosure after the profit after tax, that is other comprehensive income. So you have to include them under other comprehensive income, and the surplus on revaluation is for surplus of the building. And in the earlier part here, this is also for building. So a separate asset revaluation reserve account shall be maintained for separate asset. Next, would be the presentation in the statement of changes in equity. You can see the surplus presented in the asset revaluation reserve heading in the statement of changes in equity. Next is the presentation disclosure, in the notes on property, plant and equipment, showing the movement. So these are the movement where you will see the elimination being done in the cost and the accumulated depreciation section. The elimination of the accumulated depreciation prior to the revaluation. And the fair value of the asset is in the cost of the building, and the carrying amount is 170,000 here. This is the revalued amount, which is cost, which is the fair value minus the accumulated depreciation. But here there is no depreciation because this is at the end of the year. So depreciation has all been eliminated. So it will be the following year that you will start calculating depreciation based on the revalued amount. This is the presentation in the statement of financial position. The property, plant and equipment is shown under non-current asset, and the asset revaluation reserve is actually part of the reserve here. So maybe here there is retained profit, general reserve. It should also include the addition of the asset revaluation reserve here. So it shall be put together. Next is the explanation of accounting treatment. So the explanation of accounting treatment in a simple way, you can refer to the tabular workings that I've provided. And the first thing is to explain about the accumulated depreciation that you need to eliminate. The second one is to explain on the surplus what are the accounting treatment, where you disclose in the other comprehensive income and you show them in the movement for the surplus. And the last one is to show or to mention that the revalued amount is the one that is being recognized in the statement of financial position. And here that is using the revaluation model. A deficit on revaluation. Under the revaluation model, a deficit on revaluation would happen if the carrying amount of an item of property, plant and equipment is decreased as a result of revaluation. Decrease, or this is going downward. So therefore, what would happen is that here carrying amount would be greater than the fair value. So that will give rise to a deficit on revaluation, or also known as loss on revaluation, also known as revaluation deficit, where carrying amount is greater than the fair value. So let's look at this example of example 6. Cost of a building was 200,000, and that was at the beginning of the year. And the opening balance, similar to example 5, 40,000. Same goes like in example 5. The accumulated depreciation was 10,000. What is the difference in this example is that the fair value is no longer 170,000 as per example 5, but here the fair value is 110. All other details are the same. Buildings are still being revalued at the end of the year. And the current year here is 31st of December 2008. So here what was changed is just the fair value information. The rest are the same. So the answer here, if you can see, the carrying amount is just like in example 5. You need to work out the surplus, and the accumulated depreciation that you eliminate is still the same, and only that the carrying amount is now greater than the carrying amount, the fair value. Carrying amount is 150,000. You can see this in green, and the fair value is 110, and therefore it gives rise to a deficit. Deficit is an expense, and remember, for this session, our focus is just on initial revaluation. Initial revaluation means revaluation that took place the first time. Right, next we look at the answer here, where how do we work out the surplus or deficit using a table which is more structured. So what you can do is to, if the cost is not given, find the cost, then try and find the accumulated depreciation so that you can take the cost and deduct the accumulated depreciation, and so that you can arrive at the carrying amount. So you need to find this. As you try to find the cost, you have found them because it's given. Now you need to go and find the accumulated depreciation as at 31st of December 2000 x 8 on the revaluation date. It is 50,000, and this is after adding the 10,000 current year depreciation charge to the accumulated depreciation opening balance of 40,000. So there goes this 50,000. And because of that, your carrying amount is 150. That was number 4. And the next one is for you to compare that carrying amount with the fair value. And if you compare, you can see that the carrying amount is greater than the fair value, and there is a deficit or loss on revaluation of 40,000. You can also write your journal entry here. For example, this needs a journal entry. This is going to be JE1. This one also needs a journal entry, JE2. And the last one is for the deficit. So 3 journal entry is needed. Number 1, 2, and 3. The one that I have included here. Next, this is the journal entry number 1. Based on what I've just written just now. Debit depreciation of the building. Record the depreciation. After you have recorded, remember the revaluation took place at the end of the year. Eliminate. Same goes like in example 5. Only that now we don't have surplus, and this is a deficit. And the deficit is 40,000. Deficit will be charged in the profit or loss account, and normally deficit will be reported under the admin expenses. So under admin expense, if there is other expense together with you have other admin expense like depreciation, the revaluation deficit is also part of the admin expense. But the debit credit is where you debit revaluation deficit in the statement of profit or loss. This holds true if this is looking at initial revaluation, and we are just focusing on first time revaluation. Initial means first time revaluation. If it's subsequent depreciation, this may not be the case. This is the presentation in the statement of profit or loss. Just look at those part here where you have depreciation and deficit, and there is nothing here under the other comprehensive income. Other comprehensive income will report the surplus. And this is again initial revaluation. So the deficit is being presented in the statement of profit or loss as part of expenses or admin expenses. Next is the movement of PPE for the disclosure part. You would see that the cost section of the building is showing 110. And if you look the same situation here, the fair value now is 110, and there is no depreciation since they have been eliminated. It leaves the carrying amount to be at revalued amount of 110,000 as well, because the accumulated depreciation has been eliminated. Next is the presentation in the statement of financial position. It's the same thing that should have been shown at the revalued amount. And there are no changes to the reserve because there are none to be credited to the ARR or the asset revaluation reserve. Next is the next example here, which is actually asking to explain the accounting treatment. So remember, this is based on example 6, and the advice will be on the revaluation for the case here that give rise to a deficit. So eliminate the accumulated depreciation and mention that in the first explanation. Then what to do with the revaluation deficit, show them as expense in the SOPL and statement and profit or loss and other comprehensive income. There is no disclosure in the statement of in the other comprehensive income. And lastly is the revalued amount to be recognized in the statement of financial position as part of the non-current asset PPE. Next we go to example 7. Example 7 is on revaluation of non-depreciable asset. Non-depreciable asset like land or maybe freehold land, which do not depreciate in value. Land normally will appreciate in value. So that you have this company has a piece of land, so there is no need for us to adjust any depreciation because land is not depreciated. So it was acquired 5 years ago at 1.8 million, and beginning of the year, because for your information, year end here is different. It is not calendar year end. That was 30th of June. So the revaluation took place on 1st of January, which is actually beginning of the current year. CY is current year. So therefore, company revalued the land and the fair value of 2.5 million is at the beginning of the current year. Directors agreed to incorporate the new value or to adopt the revaluation model. You asked to advise the accounting treatment. So the first thing is always to determine whether there is a surplus or deficit. And here the carrying amount of 1.8 is actually at cost. Why at cost? Because no depreciation. So no depreciation because it is a non-depreciable asset. So you just simply compare 2.5 million with the carrying amount that is at cost. And that gives you surplus of 700,000. Remember, the carrying amount is the cost acquired 5 years ago as land is a non-depreciable PPE. Next, we go to the surplus on revaluation. How do we record that in the journal? So debit land and credit asset revaluation reserve. Here is related to land. Don't go and mix up with the one of the building. And that is the only journal entry needed. No need for you to go and record depreciation. No need to eliminate any accumulated depreciation simply because land is a non-depreciable asset. But the accounting treatment is shorter. The surplus should be shown in the other comprehensive income and also shown under the equity in the ARR, asset revaluation reserve, in the statement of changes in equity, and the revalued amount is recognized in the statement of financial position. Next is example 8. Example 8 is on revaluation of depreciable asset at the beginning of the year. Similar to what we have done, only that now we are focusing on depreciable asset back again. 1st of January 2000 X8, the cost of a building. So this is the beginning of the year. The cost of the building and accumulated depreciation. The accumulated depreciation was 64. Cost of the building was 800,000. This is the cost on the date it was acquired, perhaps several years ago. And on 5th of January, the building was revalued. 5th of January is at the beginning of current year, BOCY. Was revalued at 1.2 million. So this is the fair value on that date. The company depreciate building at 2% per annum using straight line method. So here there is need for us to go and calculate depreciation and do some adjustment for depreciation before we can straight away record the surplus. Company adopts revaluation model. You asked to advise the company on the accounting treatment for the revaluation of the building that was done at the beginning of the year. And to calculate depreciation for that year, after the revaluation on 5th of January, what is the depreciation expense for that particular year? And now it is back to year-end calendar year, 31st of December. Remember, in the previous example, it was 30th of June. That is the year-end in this example. So then don't get mixed up with that, yeah? Okay, now let's look at our focus here, which is to advise. Before we advise, I would like you to just learn a little bit on how to work out the surplus and deficit for the revaluation of depreciable asset at the beginning of the year. Then we'll be going on to the advice section. First is to always calculate the surplus or deficit. Here is a surplus, and what happened would be to take the cost minus accumulated depreciation. In this question, the accumulated depreciation is given to you. You don't have to work it out. The one at the beginning of the year or the balance brought forward is given. And the revaluation took place also on somewhere beginning of the year, 5th January. So you just there is no depreciation being charged in the year yet, and you decided to revalue the beginning of the year. So cost is the cost as at the date of purchase. Accumulated depreciation here is where the date of revaluation DOR is at the beginning of the year. Right, that was the date of revaluation. So the fair value is greater than the carrying amount. The revaluation surplus was 464. Okay, and let's look at the advice. After we have done that, I skip the journal entry section. You can try and take your time to do that. And this is the advice. Remember, your first advice is always on what to do with the accumulated depreciation prior to the revaluation, and that was given to be 84,000. It shall be eliminated against the carrying amount or the cost of the building. The second one is to explain on the revaluation surplus itself. First, explain where you have to disclose in the other comprehensive income. The second part is to show where it is being credited to asset revaluation reserve that relates to the building that is reported later in the statement of changes in equity. The last one is to mention about the revalued amount that is recognized in the company statement of financial position immediately after the revaluation at the beginning of the year. So this is happening when? On 5th of January, beginning of the current year. So we are just looking at the one as at 5th of January. Now let's look at the calculation of depreciation for the year ended 31st of December, meaning that it is from the date of revaluation, 5th of January 20x8 until 31st of December 20x8. So this is for one whole year, 1 year. Depreciation for 1 year. And if after the revaluation, the subsequent depreciation or the depreciation that follows will be based or recalculated based on the fair value on the revaluation date. So the fair value was 1.2, the percentage was 2%, and this is for 1 year, so you have 24,000. This is where you debit the depreciation and you will credit the accumulated depreciation of what? Of the building. So that was just a simple one. Next is for you to do that, right? Now we go to example 9. This is the revaluation of depreciable asset at the beginning of the year, but this is going to give rise to a surplus again. Yeah. After this is where the case here is we have the useful life. We are going to calculate depreciation, remember, based on the estimated useful life. So here we would see that for revaluation, it would be fair value of the building divided by estimated useful life. This is for subsequent depreciation after revaluation. So revaluation of depreciable asset at the beginning of the year. The building was acquired in year 1, 2000x1. The revaluation was done after 7 years because this is on 5th of January 2000x8 and useful life of the building was 50,000. So this is the date of revaluation and this is the useful life. The revalued amount it was being revalued at or the fair value is 1.2 million. The building used straight line method yearly basis and here you are not given a rate, so it is actually 50,000. 50,000 is actually 2%, but this is not 50,000, this is 50 years, 50 years. So 50 years, so that is the estimated useful life. The year end is 31st of December. And remember, our revaluation took place at the beginning of the year. You can see the highlights that I put here. Next is to determine the surplus and deficit, and the same thing to calculate the depreciation expense for the year ended 31st of December. Only that the way we calculate depreciation for straight line method here use the estimated useful life. So you can see the workings here that I've provided. Find the cost, 900,000. find the accumulated depreciation prior to the revaluation. It was for 7 years because it was in 2000X1 that it was being acquired, and the revaluation took place somewhere beginning of 2000X8. For 7 years up till the end of the year, depreciation has been provided for 7 years. So divided by 50 times 7, you have 126. Take the cost minus the 126,000, and then you get carrying amount 774,000. Compare that 774,000 with the fair value on the revaluation date beginning of the year, 1.2 million. Therefore, it will give you a surplus because fair value is greater than carrying amount, and that is 426,000 surplus. These are the journal entries that you should do or you should pass for the elimination of the accumulated depreciation, and also for the revaluation surplus for the building. There is no journal entry yet for the depreciation because this is at the beginning of 2000X8, which is on 5th of January. So no depreciation yet has been charged. It will be charged at the end of the year. Right. So that are the things that you need to work out. So the calculation for depreciation expense will now be, as I mentioned, fair value divided by the remaining useful life. The fair value given the question, remaining useful life, is to take the estimated useful life, which is 50 minus 7 years since the date it was acquired until the date revaluation took place. It has been 7 years. So now the remaining useful life, which is RUL, is 43. So divided by 43 times 1 year, because that revaluation took place at the beginning of the year. So it was 27,907. So the depreciation that should be charged in the SOPL as an expense, and that was the depreciation for that year, would be 27,907. And recall, after the revaluation, the subsequent depreciation expense is recalculated based on the fair value on revaluation date. And this is the fair value on the revaluation date. We recalculate. We do not base on 50 years. We base on the remaining useful life. That's why the word is recalculate. I'll see you when I will see you. This is the end of part D. We'll be having one more part E. Till then, have a nice day ahead, and I will see you when I will see you. Thank you for watching, and Assalamualaikum. Bye-bye.